So we saw bond yields, they peaked yesterday at about 4.67, 4.68, but still the market managed to churn higher yesterday with the small caps actually the best performer. What do you think led to that? Because in general, small caps are more interest rate sensitive.
Yeah, that's true, Frank. I think that the market looked at the bond yields and said, like, that's probably overstretched a bit. That's why we are down. That's actually a reasonable move, right? 468 to 454. And that alleviates the market. And I think that's what we're seeing this morning in terms of the pressure that was on the markets over the past week is easing off. But we have to remember that this is a market that's focused on a recession. It's focused on downturn. And so with these high bond yields, people are paying attention at what is this going to do to the economy. It ultimately is going to slow down. As I mentioned to you before the segment, is if all yields go up to 5% or higher, I do think there's going to be a signal from the bond market that we're going to slow down.
I want to dig into this one, Ben, because some fascinating research you put out yesterday. So this is from a note that you put out yesterday. A lot of people are worried about the inverted yield curve. You're actually really concerned about it flattening. So here's your note. In part, you says what's more likely to happen is that the 10-year moves to 5% or higher, as you were just saying, the technical round trip to 2007 highs, it could bring all Treasury yields to the same level, presumably right around 5%, which makes the yield curve shape entirely flat. And you say that is the moment that the bond market signals high uncertainty in the economy. So this is a pretty extreme scenario. I mean, it's a lot of movement in the bond market. How likely do you see this happening? And then you're saying it signals uncertainty. What is it exactly signaling?
Yeah, so as you see the dynamic playing out now, right? The 10 years moving closer to the 2 years. That difference is now less than 50 basis points. And this is still about growth, about a strong economy and about the Treasury supply, all those factors we mentioned, and the Federal Reserve. But when you get to a point where a 2-year, a 5-year, 10-year, 30-year have the same yields, it gives investors the view of like something is not off, is off here. Like it could be really a yield that's going to stay for 30 years or 5% or for 2 years. We don't really know. That causes a lot of uncertainty. Plus, a 2-year yield transmits differently through the economy than a 30-year yield. 30 years about mortgages, 2 yields more about, say, corporations, financing. So you're getting everywhere high rates at the same level. I think that is what the bond market says. Now you have uncertainty in the economy. Now it could really start slowing down. Yeah.
I want to stick with Treasuries for a minute. Also important to note, the 30-year hit its high since about 2011 yesterday. So we had some pretty big calls from our Delivering Alpha Summit yesterday from Pershing Square's Bill Ackman, also BlackRock's Rick Rieder. They're in agreement about what's going on the long end of the curve. Take a listen.
We have probably the worst technical environment in our lifetimes for supply of bonds versus buyer bonds, right? We have China selling. We have Russia, to the extent they own U.S. securities and more, selling. We have Saudi Arabia selling. And we have an economy that is still strong and inflation, 3.5%, 4%, persistent. But, our view is basically you're not being paid enough to enter into a 30-year contract with the U.S. government at a fixed price. 4.7 or wherever it is now. It doesn't make sense in a world where we think structural inflation is north of 3% for the very long term.
So when you think about where real rates are, you're buying a 5-year note. If you assume inflation is going to, let's say we settle at 2.5 to 3, you're getting paid a couple hundred basis points or more in real rate to lock these rates in. So I think you can extend a little bit out the curve, but the idea that I got to buy 30 years in an inverted yield curve, when it's not a hedge, you think about portfolio allocation, it used to be a hedge because for 30 years, rates came down, we were in a stable low inflation environment. Today, if inflation's higher, the back end of the yield curve is going to get hit the same time equities are going to get hit. It's not a hedge, it's actually compounds a potential downside. So we like being in the front now a bit to the belly of the curve.
All right, so right now, 30-year at 4.67 when it comes to yield. So agree, disagree with what Rieder and Ackman had to say?
I definitely agree with Rick. You're right. If you buy a 30-year bond at a lower yield than a 2-year, you're taking a lot of duration risk, as we say. If inflation stays higher, which is what it looks like, and if this next energy move that we're seeing now keeps CPI elevated, then you don't get paid enough yield for the duration risk, the interest rate risk that you take on 30-year bonds. So you have to move, everything has to move to the same level, Frank, in order to actually get a better compensation for the risk in the future.
All right, so we're doing a lot of bond talk today.
Yeah.
So you agree with Rieder, you don't like the long end of the curve. You like the short end of the curve? Are you talking a 2-year, a 1 month? Like, where would you put money, just very quickly, on the short end of the curve? What do you think the best bet is right now?
Yeah, I think anywhere between 3 months up to about 4 years of maturity. That's the nice sweet spot of the yield curve. You're getting not only the highest yield, But you're also getting yield that's now pretty stable. We haven't seen much change there. It's really playing out on the long end. So I think it's a good play there to be in the short end.